Welcome to this webinar today. Hello, Isaac. I hope everyone has a very nice day so far. How is trading going, guys? Any currency pairs from yesterday? For those who are participating in the morning briefing sessions where we analyzing the pairs, the markets, please feel free to type any questions you have on the chat below. And this webinar today, it's gonna be very, very interesting because especially for those who maybe not have the chance to be live on the webinar now, but you're gonna watch us later on the YouTube, you will guys see how everything slowly comes and bend together. And by the end of this webinar, I'm sure you're gonna have some very instructive guidelines on your trading. So I want you to get excited and let's go through. As always, this content is for general information only and not for any personal advice. So what price action setups I'm using for so many years for high quality entries? Guys, there are so many price action candlestick patterns, combination of candlestick patterns, which you can use, and you can find success in the financial markets and in the digital currencies and in commodities, shares, in all the tradable assets. However, when it comes to selection, if we select our criteria of how we're going to enter the market very carefully, we increase the probabilities to experience more winning than losing trades and to be ahead of the game more often. Let's go through. Here at Admirals, for those who are new, we are a well-established broker. You can trade with us with more than 8,000 financial instruments. We have support in maybe any language can come to your mind right now. We hold licenses by the Cyprus Commission Exchange, the FCA, the Estonian EFSA, and in Australia, the ASIC. Our spreads, we try to keep them as minimal as possible for your own benefit when you enter and exiting the trades. And you can trade with us using MT5 and MetaTrader 4 platforms. You can do it through the web, or you can download them on your computers, even on your smartphones for Android and for iOS devices. If you haven't, please go to your Instagram. I'm gonna give you on the chat now the links, so it's gonna be way easier for you guys. Let me just bring them up. So here you are. I write the Instagram account so you can follow us, because we put so much content out there, and really it's gonna only positively impact you by receiving the notifications. Then you have the Telegram. Whenever we are going live, we post on the Telegram, so you guys know in case you forgot to subscribe to a webinar or to a morning briefing, so you will make sure you're not going to miss out. And please, guys, the YouTube, it's so important for your trading path, because all the recordings, they go there. We go live as well on YouTube. You can have the chance to read the content again and again and again, and listen and watch the webinars. And of course, because it helps as well us, but myself, when I do the webinars and the other hosts, please like the videos, leave any comments if you have, whatever you want to ask, maybe some questions about the webinar you are watching on the record. That will be very, very appreciated. And for myself, I will take just 30 seconds to introduce myself for those who join us for first time. My name is Theo. I'm trading and investing for so much time now. I hold a master in physics. That's my education in the physics and maths. When it comes to investing, I keep a long-term investing approach. I prefer automotive companies and some companies from the NASDAQ. And when it comes to trading, I like the swing trading and not much the intraday trading now because of the work schedule. So I prefer to keep my trading not taking so much of my time in front of the screen. Now, what's for today? As I mentioned earlier in the title, candlestick pattern, the best of the best, that's how I call them, the lucrative candlestick patterns, in which time frames and under what market conditions are best applicable. They can be applied, let's make it clear, everything can be applied in all time frames, in all market conditions. Take a random candlestick pattern, throw it at any time frame, 1 minute chart, 5 minute chart, daily charts, wherever. You're going to find winnings, you're going to find losing trades. But when we are about to become consistent, we have to have a structure. We have to know where our candlestick patterns have the best probable outcome, where they give us high probability trades, and that's where we want to be more engaged. And at the end, I will give you the checklist I use actually. That's the one I'm using. I will give you letter by letter, so you can backtest it, you can play around with it and see what works for you. You can take some of the parts of the checklist and you can leave some of them. You can add things in the checklist, but that should be your map road for trading. If you are trading on the higher time frames, let's say. But first, as the last time, we will just go very quickly and see what did we learn from the previous webinar. Okay, just a recap for a few minutes for maybe those you didn't have the chance to watch the webinar or to be live with us the last time. So we talked about the chart patterns. In the chart patterns, we do have the continuation chart patterns, and we also have the reversal chart patterns. Now, and we said that continuation chart patterns, they are shorter in duration than the reversals. Then continuation chart patterns, we said that when we are in an uptrend, we find the symmetrical triangle, the implications are bullish, and reliable time frames, the daily and the weekly. For guys, more explanation, if you missed it, just go to the account I sent you, to the Admirals account, and you're going to find it very, very easily. I can also send you the link if you request. Just ask me here on the chat. If you want the link, I will send you directly the link. This pattern also can be found during a downtrend, a symmetrical triangle. It's the price is consolidating within one upcline and one decline trend lines, and then a breakaway of this triangle usually has bearish implications. And again, it's best applicable on the higher time frames. Then, very, very, very often we see these continuation patterns, which is the flag and the pennant. Both of them, they are found most of the times in the uptrends, more often, not most of the times, just more often in the uptrends. And we can identify them by the strong impulse move they create. This long impulse move, and then the market starts consolidating for a while, and then it breaks away of this consolidation. Then we have the reversal chart patterns. Among the strongest reversal chart patterns are the head and shoulders, the double top and the double bottom. I rush myself to the next slide. So the double top is when the market is in an uptrend, and at some point it's not able to create a new high, and then we see the sellers pushing the price lower, creating a new structure, which the B and C it's lower lows, and then the C and E it's lower highs, and it has bearish implications. Then we have, on the contrary, the double bottom. We found this pattern during a downtrend, and it has bullish implication because the market shows that it's unable to make new lows at point B, and it creates new high at point D, which this high is higher than the point C. So we have a higher high. We wait for the price to pull back at a value area, which usually it's the last swing, which is the C. And from there, we see the market takes off. Then we have the head and shoulders, which it takes more time for this chart pattern to develop, but when it develops, it's one of the best patterns. It's one of the most accurate patterns, I can say, based on my trading experience. I traded a lot on the daily charts and sometimes on the 4-hour charts, but usually on the daily charts, it's a no-brainer for me, this pattern. And what it says is this, that during an uptrend, the market is behaving normally, trying to make a pullback. The pullback is very deep, as we see, pullback or retracement, the same. It's very deep. The market, it doesn't stop at the previous swing after this high, and it pullbacks almost at where it started. And then the buyers are unable to create a new high. And at point E, the sellers push the price lower. So we have this like head and two shoulders, left and right formation. So we wait for a pullback, and it has bearish implications. And as I said, it's one of the very, I can say, accurate reversal trading patterns for me. And the opposite we find in a downtrend, the inverse head and shoulders. We have the head at the bottom, left shoulder, right shoulder. The market is unable to make new lows, and at point E, the buyers, they stepped in and they create this higher high. We have this higher low. We wait for a retracement, and we can enter the market long. Now, let's go to the today's stuff. Candlestick chart patterns. So one of the basically most of my trades are based on the engulfing candles. We can find the engulfing candles in many time frames. Everywhere we can find it during an uptrend, during a downtrend, in the middle of the charts, at the top, at the end, everywhere. However, there are some criteria which I strictly use, and I encourage you to take them into consideration, because it's not just we see an engulfing and we jump and we press a trigger and we start trading. No, the engulfing, it has to be printed at an area where it has high probability of work in our favor. Now, I will explain you everything what I mean by that. So first, let's have a look and let's see the anatomy of a good engulfing. I will start from the characteristics of the best engulfings. And one of the characteristics I use, and I am very strict with that, I want the open the close, the high, and the low of the previous candle to be completely engulfed by, of course, the engulfing. The white candle here, it has this upper and lower tail, small tail. It has the open at this level and the close at that level. And this is a bullish candle because the close is higher than the open, and that's why the color is white. Some people, they like to see this color with green, with brown, with whatever colors. I just use black and white. So we have this bullish candle. Then what happened? The next candle opened pretty much at the same level where this one closed. It moved to the upside at some point during the time frame of this candle. Let's say if we are assuming that we are reviewing daily candlesticks, so this represents the transaction of a day. This also represents the transaction of a day. So at some point on the day, this candle opens here, normally makes a move to the upside. Everybody believes that we have a new higher high in the market, so we start buying, press the buy button, and by the end of this candlestick duration, by the end of this day, let's say, the sellers, they stepped in, they push the price lower, they make a new low. So that was the low of the bullish candle. They make a new low, this bearish candle, and they do close lower from this candle here. They totally engulf all the four parts of this bullish candle, totally. Let's see, let's explain the bullish engulfing candle. This one was the bearish engulfing because it closed lower. The bullish engulfing, we have prior a bearish candle where the open is here and the close is there. Then the next candle open pretty much around the same area with the close of the previous candle. It makes a move to the downside. It's misleading everyone that we are going short, the market is selling off, we created a new lower low or equal low. And then by the end of this session, by the end of this day, the buyers, they step in and they push the price, and they close higher than the high of the previous candle. So this candle is totally engulfed by this bullish candle. So we have a bullish engulfing, and here we have a bearish engulfing. Guys, at this point, I would like to simply ask you if everyone understand what we say, if everything is clear for you. Please, I would like to have a bit of your participation because it is important. I want to know that you guys understand what we are talking about. Oh, good. Yes. Okay. So let's read it here. In a bearish engulfing pattern, usually the black candle open in a bearish engulfing pattern. Usually the black candle open near the close of the white candle, open near the close of the white candle, move up, take out the high of the white candle, and by the end of the session, moves down and close below the low of the white candle. And the same here, it opens around the close of the previous, takes the low, make a push to the upside and close higher. All right, now I put a schematic here, which for many of you, I believe it's easy to understand that this shows a market that it's in a downtrend, and this shows a market that it's in an uptrend. Let me just grab a drawing tool so it will be easy to navigate. So we have this impulse move to the downside, we have this retracement, and the market it's selling off. Okay, so we can definitely say that this market it's moving in which direction, guys? This market here, in which direction based on this pattern here you believe is moving? Is it the downtrend or is it an uptrend? I see some downs coming in, down, downtrend. Okay, that's brilliant. Thank you so much. It is a downtrend, correct? So we have a lower low and we have a lower high here. So based on the checklist, you will see later on, when the market is in a downtrend, we are looking to sell and only sell. We don't try to buy here because, as I explained you in another session, we do not know how aggressive the buyers will be to push the price to the upside and with which way they're going to push the price to the upside. Because if they're going to go like this and they're going to just making this nonsense impulse moves and retracements, then wherever you're going to place your stop loss to buy, you're going to be shaken out of the market because the market is going to retrace so deep, which you won't be able to get any good trades out of that. But if we are patient and we wait for price to come to a level of retesting the last swing low, which usually the price comes to this point, that's the one point, or you can wait for price to come to a FIB retracement area, which I will show you later. Then or if you are using moving averages and you see the moving averages interact with the price, then you are in a high probability area of retracement. That's where we are waiting to see these engulfing patterns. Do you guys understand this? We want to be patient and wait at an area of retracement. And when we see the price arriving at that area, then we're going to start monitoring the price action there. And if we see bearish engulfing in a downtrend, we must be all over. Take the trade, no hesitation. There are few different types of participating in this market. One aggressive way, which I personally do it, I put, when I see the buyers, they take out the high of this candlestick, I put alerts, and then I have a sell stop here, sell stop, a stop order. I have my stop loss protective stop above the high of this candle here, and then I have the target to the last swing, and I will try to get into trades that they give more than 2-to-1 or at least 2-to-1 reward to risk. Okay, the more consecutive way to trade it is to completely wait for the completion of the pattern and then either enter straight on the close. You enter here, up, you have your protective stop there, and you have your take profit down here at the last swing, or at least to scale out at the last swing low, because we don't know how the market is going to react when it touches this point here. And then the other way, which very often I see the market behaving this way, is the day after, or if this is a 4-hour candle, the next session, the market usually retraces somewhere to 50% of the engulfing candle. So you can have a limit order here limit order, you can have your protective stop above the high of the engulfing, and then you have much more room to make greater reward to risk. And this is the consecutive way, and it's, in my opinion, it's very, very good way of trading. And I traded always a lot this way. If I miss trades here, I definitely try to get into it from this point of view. However, many times the market does not retrace back and it's just selling off. So we have to live with that, okay? Because we don't know, and there is no guarantee that all the time the market is going to retrace back to give us the entry we want. That's not going to happen all the time. Then the bullish engulfing. I assume that everyone understands that this is an uptrend, right? We have a series of higher highs, and then we have a higher lows, correct, guys? Now we are going to see an uptrend example. Now, in an uptrend, we will be alert at the previous swing point to see a strong price action. Maybe you can draw your fib from here to there, and you can see that you are in between the 50% area and 61.8% retracement. So it's also very, very strong confirmation. Or if you are using moving averages and you see that the price it's above the moving average, or even it's interacting with one moving average, then that's also a good confirmation. And what we want to see this massive shift in the momentum. We want to see the market opens here. We want the sellers to take control and create a new structure, a new lower in the market. And then we want the buyers to step in and snap back and close much higher than what it was the previous candle high. This shows incredible amount of volume in the different direction. This shows that buyers are in control in line with an uptrend. We have one of the strongest price action in the candlesticks, and that's where we want to be traded. Again, the entries are three. You can have the consecutive entry. The more conservative, you can put your entry here, your stop below here, and you can target more than 1-to-1 up there. You can also just enter right on the close on the engulfing, your stop below here, or you can place a pending order to get into the break of this candle here. Which one I recommend? It's the limit order, because it's more conservative, and it's sometimes the market doesn't come back to give you the entry, but really when it comes back and it gives you the entry, you have higher reward to risk ratio. So if you ask me which one of the three you recommend, I would say the third one. All right, guys, everything clear so far? Should I go to the next price action? Do you guys understand what we say? Is it clear? How do we identify a strong engulfing? Guys, again, that's really important. I don't want the engulfing to engulf only the previous candle body. I want in this particular downtrend, I want the buyers to mislead the market participants and create a new high. Everyone thinks that the market is going to keep moving higher, but the sellers, they take the power and they push the market strongly to close below the low of the previous candle. Okay, that's a strong bearish engulfing. And on the contrary, we want the sellers to create a new low and then the buyers to show dominance in the trend. All right, cool. Let's move to the next one. And the second one is the pin bars or shooting stars or hammer, depends on which trend we are watching them. So a bearish pin bar or shooting star. Characteristics of the best pin bars are the bodies to be considerably smaller than the length of the tail. Again, the body to be considerably smaller than the total length of the tail. So, and for those who are constantly participating in the webinars, because I've noticed some names and I see them in all the webinars, and well done, guys, not only on my webinars, but also on Paul's and Jens webinars. Guys, Paul Wallen's made an incredible webinar last time, and he spoke about pin bars intensively. So I will definitely encourage you to go and watch this professional guy explaining about the pin bars, because he gives more information. In this webinar today, I would like you to understand really well the checklist, the engulfings, and I know that Paul done a great job with the pin bar, so I'll just share the link here. Okay, Isaac, I will share the links, so you can watch that as well. And a bullish pin bar, or we call it hammer. Again, the body has to be considerably smaller than the length of the tail. So what do these price action represents, and why do as traders we care about a pin bar or a shooting star in a downtrend? So it simply shows rejection of the buyers over the same trading session when we are talking about a bearish pin bar. Let me make it a bit different this time. I will draw not a candlestick, but a bar chart, and you're gonna see the representation a bit easier. This bearish pin bar can be drawn in a bar chart like this. The open is here. The market starts trading to the upside, so the buyers are in control. Let's say we are watching daily charts. Then during the same day, at some point, the sellers, they stepped in, they reverse 100% the move, and they close here. So here it's the open and here it's the close. This is a bar chart, okay? So what do we see in a pin bar is the massive rejection in a bearish pin bar, the massive rejection of the buyers by the sellers. And within the same trading session, the price shows that the higher prices rejected and sellers are most likely in control of this market. All right, and the same applies with the hammer or bullish pin bar. The market opens here. See this, it's a downtrend here. It's a retracement. We are in an uptrend. Yes, higher highs, higher lows. And we have this retracement. So the candlesticks, they move down, or the bar charts, they are moving down. Then at some point around the last swing, the market opens there. The sellers, they are still selling. The buyers, they stepped in. And by the end of the session, they close here. They open there and they close there. So this shows that the lower prices are rejected and the buyers are in control. So someone expects that the next candle after this bullish pin bar or hammer, it's going to be a bullish candle. And the same here. Someone expects that the next candle after this bearish pin bar or shooting star, it's going to be a bearish candle, which is going to open here and it's going to close lower than at least where it opens. I say usually because we don't know exactly. Sometimes it just doesn't happen. However, where the high probability comes to blend with that, it comes to blend in the overall market structure. And as you can see here, we have a series of lower lows and lower highs. And at some point here, maybe around the trend line resistance, or maybe the last swing in the market, or maybe a Fibonacci retracement area, the market will be rejected and we will see a bearish pin bar. That's the first thing. We observe in the area we have interest to trade, what price action is going to appear. If the pin bar is going to appear, then we have to go to the second thing, which is to see the anatomy of the pin bar. Does this pin bar have a long produced tail and a relatively small body comparing to its tail? If yes, then we will go to our checklist. If 1, 2, 3, 4 points are in a line, then we do not hesitate. We enter right at the close. Our stop above the high of the pin bar, we can target the lower part of the trend. Same here. If the checklist agrees with that and the pin bar is a well defined in terms of a good characteristic pin bar, then we place our entry here, we can place our stop here, and we can take our profit somewhere around the top. However, there are some occasions, and that comes from my experience as an active trader, there are pin bars, they have massive long tails, which if we say on the daily or on the daily chart, this can be even 200 pips. 200 pips is a quite large stop because we want to make at least 400 or 300 pips in order to have high probability, to be in a high probability area. So when the tail is very long, usually the pin bars retrace somewhere around the 50% of their total length. So the next session or the next sessions, they retrace somewhere around the 50% of the pin bar. So we can have a limit entry here. We can have a stop there. And we have higher rewards to risk ratio. The same applies with the bearish pin bar. I just make them a little bit smaller here because I couldn't use the whole slide for that. So when it's a small pin bar around, let's say 50 pips, 80 pips on the daily chart, definitely we can enter here, we can place the stop here, and we can take the profit somewhere at the bottom. But when it comes 100, 120, 200 pips, I prefer to take the more conservative way and wait for some retracement around the middle. So I have a limit order here. That's a sell limit. The stop again at the same place and target the lower point of the major trend. Jacob asked, how many pips would you put stop loss above? Now, we put the stop loss above. Of course, if we are in a downtrend, I will take in consideration the spread plus a couple of pips. So if we are trading, let's say the Euro USD, usually a typical spread is about 0.8. Just I will round it to 1 pip, just assuming. So if the spread is 1 pip, I will put plus a couple of pips, 2 pips, plus 1 pip, 3 pips, and I will put my stop there. Now, Again, from my trading experience, if you're going to trade pairs like New Zealand, minor pairs, not majors, so pairs which they don't have the US dollar involved, if you're going to take Euro New Zealand or New Zealand Canadian dollar or pound New Zealand, pound CAD, usually because they have spread about 4, 5, sometimes 6 pips in these occasions, I'm gonna give a little bit more from 2 pips. On the daily chart, I will give another 2 pips just because when they move, and if they have a spread of 5 or 6 pips, I will just give a little bit more room for this extra error. Okay. Osman, one questions. Yes, are the trend lines upside down? Trend must be with shooting star and downtrend with hammer. This is the way we trend reversal with these chart patterns. Hold on, this is a downtrend, and excuse me if I didn't put this in a correct order. Sorry, I will double check it. Someone has a different opinion, and that's accepted. Just keep the pin bar, bearish pin bar and bullish pin bar, just to avoid any confusions, because these are some from a Japanese candlestick book. If you're gonna just Google it, you can read it, and it has hundreds of different names about the candles. Depends on how long it's their body and their shadow and so on and so forth. Okay, Anthony, yes, this video will definitely be available. I think tomorrow it's going to be uploaded on the YouTube channel. So I will, as far as I understand, guys, I think I need to show you exactly on YouTube channel how to go through the webinar, so you know how you can find all the webinars. Just very simple. Okay, and that's in regards to the live webinars and also to the afternoon webinars we are doing now. So I will just leave a few minutes at the end to go through. So again, we are in a downtrend, and we want to see a bearish pin bar at an area of interest. This area, it's going to be either a last swing in the market or a fib retracement or moving average. So this market, it's in an uptrend because we have higher highs. If we have moving average, they're going to point it to the upside. So we see a bullish pin bar here somewhere around the last swing. We can definitely take this trade to the upside. Now, in an uptrend, when we see the market make these higher highs and higher lows, again, we call the turning point, we call them swings in the market, regardless, uptrend, downtrend. So when we see this type of market condition, we do not attempt to use the bearish pin bar and the bearish engulfing to get onto the retracements. We don't, simply because they are extremely low probability trades. Not because they do not work sometimes, they do work. And sometimes when you see engulfings right at the top of pin bars, they do work really well. But statistically, how many times they work and how many times they don't, and how much it's the reward risk ratio they give you every time they work, in case you can recover some losses when they don't work. I will challenge you if you want to backtest this before you have the temptation to start using it. But I've done it from myself, and I find out that the counter trend trades, like the retracement entries, are very low probability trades with all price action. So when we see an uptrend, we are in the guard around the last swings points of interest, and we are focusing on this area here, bullish pin bar and bullish engulfing. All right, guys, if you want to take some screenshots, you are allowed it. Take some notes, please. Make sure you really start paying attention to in your trading when you are using the candlestick patterns, especially with the bullish engulfing and the pin bars in the uptrend. So you increase drastically the probabilities of good trade. Downtrend. We see a series of lower highs and lower lows. What does it mean? It means that we are in a bearish momentum. Do I want to start buying on the reverse, on the retracements? No, I don't want to buy on the bullish engulfing or on the bullish pin bars. I don't want to do that because I'm in a downtrend, and when we're in a downtrend, we sell and only sell. Instead, we would like to see the market retrace at some point of value or at some discount areas. We have our pin bar or bearish engulfing, bearish pin bar. We start getting involved with these markets. Okay. Guys, so far everything is understandable. Is it everything clear? So we sell with bearish pin bars and with bearish engulfings, and we buy with bullish engulfings and with bullish pin bars. Then what happens when the market is just on trending and it's moving from the one edge to the other? Like it happened recently, and we talked about that in the morning briefings, and that was the Euro Canadian dollar on the daily chart, and we took some trades based exactly on this schematic here. The market, let's say it's coming to the downside. At some point, it behaves as normally, retracement here. Let's say we are in a downtrend, so we initiate, we find the bearish pin bar or a bearish engulfing, we initiate the position, and we take our profits around this low point. And then here we surprisingly see a bullish engulfing candle at this area here. It shows that sellers, they didn't have a power to push lower the market, and instantly the buyers, they took control, and we see the market climb and come and retesting this level with another either bearish engulfing or bearish pin bar. So we have 2 points, we can draw a line, we have another 2 points, we can draw a line. So we observe that this market is top trending and it's in a range boundary areas. So we can start selling from the top and we can start buying at the bottom, but we have to be extremely accurate on this with our candlestick entries. When we are in a range, we do not know at which point the market is going to stop and change either direction and create a new trend, or it's going to pause and resume the original trend, which we said for this example, it was a downtrend. And because of that, at the key areas, we would like to see only strong price action. Strong price action. I want to see a bearish engulfing, a nice and defined bearish engulfing, indicates that sellers are in control and increases the probability of this market to sell off at least until the middle, at least. And then at the bottom, I would like to see bullish engulfing to indicate that the buyers, they are aggressive and they want to push this market to the upside. If I will see something else beyond these two type of candlesticks, especially in a range market, I never ever enter the market. I know that some inside bars, they often offer many lucrative trades in terms of reward to risk. However, purely from my experience, purely from my trading and only trading activity, I observe and I experience more winning trades with bullish engulfings around key levels and with bearish engulfings around key levels as well. Okay. So, guys, how do you feel so far? Are you ready for the last and final? Excuse me for that. So, last checklist for entering the trade. Guys, please take a screenshot of this or write it down, whatever it's easier for you, backtest it and apply it. That's how I trade. I can't be more, I can't make it more obvious to you guys. It's high probability execution setups, and you can definitely give it a shot. You can try it on a demo account, and I encourage you, everything you see as new from me or from other educators or other traders, when we say something, please have a demo account on the side and backtest everything, because before you put your money into any trades that you have no idea, it's just because you hear it from someone else. Okay, so I challenge you to just try it first, feel confident, see how you can bring it down to your personality, and put yourself in it and just apply it the way it's going to be better for you. But in trending market, what do I want to see? I want to see a horizontal support or resistance. If we are in an uptrend, I want to see a support. If we are in a downtrend, I want to see a resistance on the daily or the weekly chart. For those who are watching the morning briefings webinars with me, you will know by now that we go on the daily and on the weekly chart, and we find the hard levels of support and resistance. Then we are going down to the daily chart. We use the Fibonacci retracement to see the areas of, let's say we are in an uptrend, the market is moving up and it starts moving down. We're going to use the Fib retracement from here to there, and we would like to see the market come somewhere and reach this support. But if the Fib retracement matches with the 50% or the 61.8%, it will be a double confirmation. So that's highly encouraged to this trade. So that's the second, the Fib. The third, it's the trend line. If I can draw a trend line and the market, it's going to come to retest the trend line, the way I put it out, it's like the market, it's in a rhythm. The market, it's in a mode. It's just have a stable rhythm and it's moving before the expansion, let's say, it's going to come, or some crazy orders, they're going to hit the market and then it's going to just going like this in a steep move to the upside. So if we can match a trend line or even moving averages, if you are using moving averages, you can have EMA, exponential moving average, here instead of trend line. Okay, so that's the third level of confluence. And then we are waiting patient. We are patient around this area here when we identified our area, and we can go then down to the 4-hour chart, and I go up to the 4-hour chart. I don't even go to the hourly charts, and I'm looking for engulfing, bullish engulfing if in an uptrend, a bearish engulfing if it's in the downtrend, or the pin bar. If I have this pattern here on the 4-hour chart, this retracement, most likely it's going to be something with lower highs and lower lows. But because I have the way that the daily is up, here it's the fib retracement of the daily, here it's the last swing of the daily. So there is weight on the buyer side. Here, if I see on the 4-hour chart a bullish engulfing, it gives me better reward to risk ratio because it's going to get me into the trade much earlier, and I'm going to have more room to make more until the last swing. And the same applies to the downtrend. Okay. Then in a ranging market, I have the sub. We know we define a range because we have 4 touches. Always, guys, to define a trend, you need more 4 points, 1, 2, 3, 4. So you have higher highs and higher lows. And in a range, you need 4 points to define the 2 edges. 1, 2 at the bottom, 1, 2 at the top. Then and only then you draw your lines, and then you are waiting. If the price is going to come here, so we have horizontal support, we have it. We have a double bottom, we saw the double bottom. And then a candlestick pattern on the daily or 4-hour chart, bullish engulfing or bullish pin bar, we can take this trade, high probability trade. When I first started trading, I was using for extra confirmation the MACD divergence. I believe we have few videos on YouTube from other traders. I don't remember if I've done myself any webinar about divergence, but MACD divergence, it's a good indicator if you want to use for a confirmation, for an extra confirmation. Okay, so pretty much that's it, guys. That's how I trade. That's how I've been trading. That's how I learned to trade. And of course, my mentors, they gave me also a checklist and so forth, but I readjust everything based to my personality, to the way I learn to interact with the market. Okay, and that's how my journey in trading is going. So we said that I will show you how to go through the YouTube channel. Guys, is everything understandable so far? Is everything clear? Do you have any questions from what we said? Yep. Okay, guys, so bear with me for a sec just to find exactly to take you through the videos. Okay. This is the live. Okay, this one is for the live, and I will prepare. All right. Let me just share the screen. Guys, everyone can see the YouTube channel. Can you please confirm so I can show you? Yes. Luis, is that yes for everything is clear, or is that yes that you can see? Okay. Okay, everyone can see. So guys, you go to the channel, I sent you the link. Then if you scroll down a little bit, you will see here the upcoming live streams. That's when I'm presenting the next one. It's on tomorrow, okay, on the 17th. And then trading spotlight, that's where we put all the webinars we do, myself, Pauls, and Jens. All right, so her brain best trading patterns, the third one here, it's the one I've done last time. Combined price action setup, I think this one here was Paul's with the pin bars, and I encourage you to basically I will encourage you to be active with your learning. I see that you are participating in all the webinars. So if you are watching live the webinars, that's absolutely fantastic. Just if you need to go back to any videos, you know, you're going to find them on the trading spotlights. On the upcoming live streams, if you want to register from the YouTube instead of the Zoom, that's how it doesn't make any difference for us. You want to see the same thing, so you can use this one here. You can see when we have events, and if you click to I think your videos, yep, you're gonna go here, so you have the videos here. You're gonna click live, and I think you can see all the, or maybe that's for me, maybe. No, I think that's only for me. Okay. Yep. And here on the spotlight, there are all the webinars we've done so far. You can just simply go and watch whichever you want. Okay. Any questions? Okay. All right, guys. Honestly, it was an absolute pleasure to host this webinar with you. Thank you so much for your active participation and for your questions. And I really encourage you to start implement this if you haven't started implement yet. So that's all from me for now. Looking forward to see you tomorrow on the morning briefing webinar. I wish you good night, good afternoon, and thank you so much. Bye-bye.